India's stock market valuations are stuck, as a recent report from Kotak Institutional Equities said, between the harsh realities of stiff valuations, domestic growth issues, and global macroeconomic headwinds, and two, the hopes of a recovery in the economy and earnings. And at that point, they were referring to the fourth quarter 24-25 results and saying that they were not providing much comfort about an imminent recovery. So here we are in the month of July and trying to understand where we stand in this valuations versus growth matrix. My guest for today is Sanjeev Prasad, Managing Director and Co-Head of Kotak Institutional Equities. And there are a range of questions I'm going to pose to him, but the key one, of course, is that where are Indian markets today in the context of valuations? And within that, what are the signals that we can take away or see which allow us to interpret whether a stock or a bunch of stocks is quoting above value or below? And more fundamentally or more intrinsically, how are companies performing and where it's going? Sanjeev, thank you so much for joining me on the core report. So I'm really picking up on your firm's approach to valuation, which has been consistent in many months, if not years, and essentially saying, at least in the recent past, about how you are valuing stocks in the Indian markets and seeing them mostly as overvalued. So I'm going to start with a report that you put out on the 1st of June, where you've talked about the Indian market being stuck between the harsh realities of stiff valuations, domestic growth issues, and global macroeconomic headwinds. So let's park that for a moment. Subsequently, around June 16th, which I think builds the, let's say, the macro case or the micro case, maybe more appropriately, you've talked about the fourth quarter Nifty 500 review, where you referred to how the weak trends continue to persist. This is essentially saying, which something that everyone has acknowledged, that growth in India Inc. as a whole, and including in your sample, is not fast enough to perhaps justify those valuations. And I'll come to a more recent one where you've talked about valuations of consumer-facing companies, and you have said that they fail all major valuation tests, absolute relative to history, relative to global flip peers, and then gone on to dive into each of those cases. And again, a lot of this is already reflected in the way we are seeing earnings and price. So for someone who's looking at the prices first and then trying to work backward, this is not news. But I guess the approach is what makes it interesting. So if I may ask you first, when did you start feeling that valuations were at a level which were not justified by the fundamentals in the Indian markets?
Well, the market as a whole, I would say it's about 18 months, starting from early last year, 2024 calendar year, that is. And for some sectors, I would say auto, cement, consumer, and within autos, more specifically two-wheelers, we have been, pretty consistent about the fact that valuations really don't have much of a fundamental, standing. And that was the case for the last several years, in fact, So views on valuation haven't changed really. The valuation concepts have been there for the last several decades. So nothing is new over there from a valuation standpoint. The question is, the context has changed dramatically, and we can dig deeper into this as we go along. But the fundamental issue, what has changed in India, is that growth rates are a lot lower now for many sectors compared to what you would have seen in the previous decade and the decades before that. And this is more evident in the consumer-facing sectors, whether it's autos, consumer staples, consumer discretionary. Last 3-4 years, growth rates have come off dramatically. So that is one change in context. And there's one more bigger change which is coming is across sectors, you are seeing a lot of changes in the market structure, etc., which is resulting in the incumbents, starting to lose the dominance which they had in their respective categories or sectors at one point in time. Markets are becoming more competitive, products are losing, I would say partly brands are losing relevance, distribution channels are no longer, as I would say strong for the incumbents as they what used to be historically. So somewhere the market is not looking at these big changes which are taking place, which would logically result in growth and profitability both for the incumbents being lower going forward. So why are the valuations, the same? That doesn't make any sense, right? If growth is going to be lower, and you are seeing that for the last 3-4 years, that is very visible, especially for the consumer-facing companies. And if the medium-term prospects are also more or less indicating the same, given the levels of disruption one is seeing, you have to have a lower multiple to start with. Your growth rates are lower, profitability is at risk. So why is the market still somewhere believing that we should continue to value these companies the way we have valued them in the past? So that is a fundamental argument against the valuation that the market seems to be discovering through many sectors in stocks currently.
Right. And I'll come back to the changes in market structure and the incumbents versus the non-incumbents in a moment. But you said 18 months is when things turned, at least in your perception. So September 2024 is when we saw the big market peak, which we have yet to go back to. So was that one turning point or even before that?
Ultimately, as an investor, you have to be very cognizant of what you are paying for stock, right? And you have to be very clear about what is the fair value of brand bonus. It can be vary 10%, 20%, that's okay. But you want to be very clear about, what is the fair value of something that you are willing to buy. I mean, it's like buying anything in the market, right? You have to be clear, okay, this is the price which the market is telling me. It's the price of the product or the price of service. But I'm not happy with that price. My view is that that particular good service should be valued at a certain level. So which is where this whole market, anyway, that's its structure. That's the reason why the market exists, right? People will have different views. And for the last 18 months, we have been feeling that many stocks are being overvalued in the context of the fundamentals of those companies and in the fundamentals of the context of the fundamentals of the sectors. And to be honest with you, Govind, last 12 months, the market has also not gone anywhere, right? It's been stuck in that very narrow band anyway. If you look at Nifty, it's just about, low single digit up. Even if you look at the mid cap and the small cap indices, despite all the, open hype around those categories, I mean, the broad indices over there are pretty much flat in the last 12 months or so. So either way, the market is, I don't know, whether recognizing that there is a valuation problem, but at least based on my conversation, I don't think I'm ready that, most people still seem to be, there's a lot of value in the market, which I struggle with honestly.
Right. And like I said, I'm going to come back to some of the sectors in a moment. But let's, if we can understand the psychology of the market as we are seeing in the manifestation of prices, of volumes, and some of the sectors that we've seen. And again, your firm has pointed out in the past the exuberance we've seen in defense stocks, for
Yeah.
example. So if I can ask you, and it's a more a layman's question perhaps, what then causes sectors or some sectors to suddenly shoot up and become market favorites, even though, let's say, institutional investors like yourself may be staying a little away?
It's ultimately expectation that matters as far as stock prices are concerned, right? At some point in time, expectations may be running well ahead of fundamentals. And that's been the case for several sectors in the last 18, 24 months in particular. We have seen a lot of new sectors in the sense, they have caught the fancy of the market. You started with this whole electrification theme, if you recollect, sometime in the middle of last year when there were some power shortages. A lot of analysts, investors, everybody got excited about the electrification theme, assuming there will be, shortage of electricity for a long period of time. That theme didn't really play out the way it was expected to. Same with when you had people getting very excited about the railway theme. Right now there's a lot of excitement around defense. So we have seen, various, sectors catching the fancy of the market. Depending on, how, I guess, the majority of the investors are looking at. And, at this point in time, of course, you've had, let's look at it this way, starting from 2021 or early 2021, let's say once the pandemic issue started, to recede in the background, all the way to late 23, early 24, the market has been a one-way around,
Mm.
and investors who came in the market obviously have made decent amount of money. And somewhere that seems to have got ingrained in the minds of retail investors that irrespective of what point in time you invest, where you invest, what price you invest, you will always make money. And that is what is resulting in this continued inflows into domestic mutual funds from retail investors. This belief that, number one, you will always make money in the market. Number two, you will make large amounts of money in the market. And number three, you will make even large amounts of money in mid cap and small cap stocks. that has somehow got ingrained in everybody's, mind. And that is what is resulting in, these sectors periodically coming and going, so that is what is at the market, you can't fight the narratives till the time, the fundamentals, start reasserting themselves. You can have this euphoria in the market for a long period of time. And then, as I said, you have seen so many sectors, catching the fancy, and then eventually, that theme or the narrative, petering out, only to be replaced by a new one. So, the cycle continues, I guess.
Okay, no, so just to dwell for a moment on the supply side, and I'm talking about fund flows.
Good.
So we've again seen record mutual fund inflows, SIP inflows again at highs. Now, what you're saying is that basically this is because investors feel that they will make lots of money, but is it also because they don't have any other choice in a high inflation environment with maybe lower or stagnant incomes? The only option that you have, at least mentally, is to put money into stock markets because you think it's likely to grow as opposed to any other form of assets.
Which is where the fallacy comes in, right? Somewhere the belief is that you will make money at every price point, which is obviously not correct, right? Let's say a stock goes from 100 to 200. It is obvious that your return expectation has to be lower now. It can't be the same as what you were expecting at 100 rupees. So, but somewhere the mentality is that you will make money at every price point. You will make decent amount of money at every price point. So that is where I really struggle with and it just based on historical experience. The 21 to 24 period has been very good. So maybe this will continue at every price point. Look, I have three fundamental, arguments against this. First of all, when people say returns in equities are going to be, let's say, better, we have no other option to invest. That is only valid when the valuations are reasonable. Right? Obviously this argument is not valid at every price point. Number two is the fact that, let's say, why are we comparing debt and equity to start with? Debt is more or less, in a way, risk-free, if I can use that term. Obviously, everything is risk, but relatively very low risk compared to equities. But somewhere, everybody is just looking at debt and equity in the same way, without looking at the fact that obviously equity has to be priced in for some risk. Whatever that may be, 3, 4, 5 percentage point higher. Some equity risk premium has to exist for equity versus debt. So this comparison that in that you will make, let's say, 5% post-tax or something like that in debt versus 9 to 10% in equities. I mean, that is okay because that's how it should be anyway, right? You have to factor in some amount of risk when you're investing in equity to start with. And if your nominal GDP growth is, let's say, 10% plus minus, that is what we are seeing for the economy now, and maybe the near term also, that is okay, fine, but to assume that at every price point you are going to make 10% return, that is a bit, I don't know. Yeah. And number three is this, belief that somehow there is money in the market. I think this is a very fundamental misconception which is there. See, money flow does not matter. It does not move stock prices. And this is a very hard to believe concept, but the simple point is that there is no money in the market at any point in time. Secondary market has zero money. Somewhere this concept is simply not understood by investors. Because at every price point, for every trade, there has to be buyer and a seller. Somebody buys, somebody sells, right? So the net amount of money in the market always has to be zero. So it's not as if flows driving the market. It is expectation of returns that is resulting in investors behaving a certain way. Now, let me explain that. What does it mean? What it means is that why is the retail community investing in every price point? It is because they expect to make money at every price point. That is why they are constantly giving money to the mutual fund saying, okay, go and invest. So unless until that changes, this mentality may continue and this behavior will continue. So let's say the market does not perform for 1, 2, 3 years. Hopefully it performs. Somewhere the return expectations start changing. Let's say the last 12 months, nobody has really made any money in the market. If you look at, the broad indices, they haven't really gone anywhere. Large cap, mid cap, small caps, they haven't done much. Obviously, individual stocks have done a lot. Some have lost money significantly also. So if stock prices do not go anywhere for some time, 12 months, trading returns start coming down, maybe that is when you start seeing some rationalization or some other rationality coming into the market. because currently people are still very convinced that they make money at every price point, and which is what is resulting in this flows into the market. But you have to understand a very basic concept that there is never any money in the market. Somebody will buy, somebody will sell at every price point. If I buy, I will take stock from you. You will take my money. That's what happens in the stock market. At every price point, every second or every nanosecond, that is what is going on in the market. There is never any money in the market, so flows do not matter. It's expected returns which matters when it comes to
Right.
stock prices.
Right. And, so most fund managers talk about markets being slave to earnings. Now,
That's true.
everyone says this.
Yeah.
But from what I'm gauging from your thoughts so far is that while everyone says that, everyone is not necessarily practicing it. Is that, would you agree with that?
Yeah, unfortunately, the problem nowadays is there's too much discussion on flows and whatnot, and less on fundamentals. So you're absolutely right in your assessment that of course earnings are the only thing that matters ultimately when it comes to stock prices, right? But somewhere data seems to have existed in the background, and a lot more discussion seems to be on flows. What is retail investor going to do? How long will he or she continue to put money in the market and whatnot? I think somewhere the discourse has to move more towards business models of companies, the disruption risk which these business models are facing now, and what does it mean for earnings eventually. Eventually, that is what matters. Where are earnings headed ultimately, right?
Right, and I'm going to come to what could be a strategy in these times in a while.
Yeah.
But let's come back to the fundamentals, and let's pick on consumer goods, a sector again where you wrote a report just recently where you talked about valuations of most consumer-facing companies failing. And just to recount that, you said they're facing on absolute valuation tests relative to history and relative to global peers, which of course is a good reminder that companies in India like Levers or Nestle quoted much higher price earnings than their MNC parents or their parents, and that's usually been seen as a big plus, which for the India growth story. But I'm sure you may have some views on that. So, if you were to pick now consumer products and what's going on there, can you walk us through some of those points that you made earlier? You talked about some fundamental changes in market structure. You talked about how incumbents are being threatened, perhaps in a way that's not happened before. And you also talked about brands losing relevance.
First of all, you look at the earnings growth of these companies in the last decade. If you look at the 2010 to 2019 period, and excluding 2020 because the last quarter FY 2020 got affected by COVID. Yeah. Most companies, consumer facing, whether staple or discretionary, they will delivering low teen to even high teen earnings growth, by the way. Lever, for example, delivered 13% earnings CAGR over the nine-year time frame. Yeah. So there was maybe a justification for the high multiples which the market is willing to give in the Sunny Lever at that point in time. I'm using HUBR as an example. And most companies in the same bracket here. And the other thing was also keep in mind the fact that post the GFC and the pre-pandemic period, you had a period of very, very low global rates. In fact, for most of the 2010 decade, we had pretty much zero normal interest rates in all of the developed countries. Yeah. So in a way, your cost of equity was also the lower side. So that could suggest between a combination of very high growth, low teen, mid-teen, high teen kind of growth, and very low risk-free rate cost of equity, you could justify whatever 40, 50 B multiple registerable the trading at. What has changed in the last 2-3 years, growth rates have come down dramatically, and we will just get into the reasons for that. But you look at the growth rates are now of some of these companies. Last 2 years, that was FY 23 to 25, Levers top line growth is 2% CAGR. Bottom line growth is 3%, by the way. Asian Paints had delivered negative revenue and bottom line growth. So obviously things have changed over here. Somewhere the market is still not taking cognizance of this fact. The expectation is that we will go back to the jolly good days of 2010 decade. I am not a believer in that for the simple reason of lot of change as far as the sectors are concerned. And jumping into the points which you made, what a change is that fundamentally market structure had deteriorated for the worse. You are seeing more and more competition coming in. You are seeing basic changes in lifestyle, consumer behavior of households and customers. All that, in my view, will result in far lower growth for certain categories of products and also risk to profitability. So you look at the 4 risks which are highlighted in the report. Number one is that brands are getting diluted. That is obvious, right? You are seeing a lot more brands being available in the market. And the reason for that is the distribution channel is now becoming a lot more, I would say, democratic. What I mean by that is earlier there was only one distribution channel, which was the general trade channel, which the incumbents used to dominate. When there was limited shelf space in a Kirana store, if you walk into a Kirana store, you would see a few brands, which have been the Kirana store been selling for the last several years or decades, and that's it. But now you have several more distribution channels which have come up. You have the entire modern retailing piece which has come up, which is the big box retailing of like DMart or Reliance Retail. You have e-commerce, you have big commerce, etc. So now the chances of a new brand getting launched and making some impact is a lot higher. You have seen a lot many D2C brands have come in, and managed to establish a niche and also grow to a reasonable size level. So that is number one. Brands are getting diluted. You're also seeing competition of private label brands of all these modern retailing companies, whether it's a Reliance or a DMart or etc. They're all launching those private label brands. So you are seeing a lot many brands getting launched. To some extent, brands are getting diluted. Distribution, which reinforce the brand power of many of these consumer staple products, that, as I said, is also getting weaker in a way. Number three is, and this may not be that relevant for consumer staples, but in many other categories, what we are seeing is what I call a standardization of products. So in a way, let's say you look at a thing like cables, wires, fittings, etc. I mean, Indian companies have been brilliant in creating brands out of these commodities. Yeah, but my view is that over time, I think the risk of these so-called brands being again reduced to semi-commodity branded products or even fully commoditized products exists. I mean, I don't know whether it will play out or not play out, but it's a risk at which the market should be cognizant of. And I'll give you one example. If you look at any of the building materials, earlier you had a situation where most houses in India were built by the the home buyer. Yeah, you buy a piece of land, respect your house, and effectively you're going to buy your own materials in a way, or you get a contractor to buy the materials. Yeah. So in a way, many of these products had a B2C relevance. Yeah. Incrementally, more and more developments of real estate in this country or in India is now based out of, it's based in the form of large developments, but large developers in the form of multi-apartment, multi-building, for developments. Yeah. So who is the buyer in that case? The buyer is now the developer, not the retail or the guy who was building his or her own house. So it's moving incrementally from a B2C channel to more of a B2B channel or B2B mode, I would say. So the chances of brand existing in that case, clearly become a lot lower. The pricing power should logically go down. Growth is not an issue. I'm not debating that point. Obviously, in India things will grow, so that is not an issue at all. But I think profitability could be at risk over here. And then you also have changing the consumer behavior. Earlier 40 years back, everybody thought alcohol was a very good thing. A glass of wine every day was very good. But incrementally, all the literature, all the academic studies, everything is proving that it's really a problem. So when do you start seeing some of this risk setting reflected in the habits of the Indian customer? GNP1 is coming, which should logically have a big impact on prepared foods, on and on alcohol also, by the way. So there are big changes which are coming through, but somewhere the market is simply ignoring all the disruption risks, whether it is brands getting diluted, distribution channels becoming lighter, products getting standardized, consumer behavior changing in a big way. Everything is adding up, in my view, to suggest lower growth rates for companies and incrementally a lot more risk to profitability.
I think that the standardization is an interesting example, Sanjeev. You've talked about the cables and wires, and I remember in the Economic Times, one of the management folks used to talk about the contrast of building a brand like Gujarat Ambuja Cement, and cement is obviously, it's tangible, but it's not something that you see in front of you, and it's really something that goes into the building of walls or buildings and so on. And what you're saying today is that after all these years, and including in cables, I mean, we have so many cable brands in India, and today it seems to matter less. Whereas at one time, maybe that was the factor that brought them some market premium.
It's a simple question to ask. Anybody is saying is a brand, so you ask them, in your house, which brand of cement is there? I can bet 19 out of 100 people will not know which brand of cement and cable have been used in the house. Because first of all, the guy may not have built the house anyway, because anyway you are going to stay in an apartment these days, right? Especially
Yeah.
in the cities. So how would you ever know what cement and what cable and wire has been used in the house? I mean, see, fine, there will still be a B2C channel over there. Don't get me wrong. For the simple reason, there still be individual houses which will get built in the smaller towns, etc. And for for replacement, there will be some demand. But otherwise, incrementally, lot of these products are going to become B2B products over a period of time.
Right. So let's come to the more fundamental question then. I mean, again, from a layman's point of view, the question is really what is then growing in the market. So, and there is some debate, as I can see, around it. So one argument is that yes, the big brands, the Levers and Nestle's are losing out on growth because others are eating in, but fundamentally the consumer is still consuming at a higher pace. The other argument is, which I guess encompasses some of the first one, is that basically consumption overall has slowed down, and there is data to that effect that the economy has slowed down, which I guess is quite evident. Consumers are consuming less, and that is having a cascading effect on all of this, which is the way the Levers and the Nestle's are selling, and added to it the additional competition that they're facing.
Yeah, so obviously there are both cyclical and structural elements over here. The cyclical part is what you referred to as the slowdown. Yeah, that's pretty clear. There is a slowdown, especially the urban poor has been struggling for the last 2-3 years. We have started to see some rural recovery. We have had 2 decent crop seasons. Even this monsoon looks okay. So hopefully, that trend of rural recovery, which we are seeing, companies have been highlighting it, that continues. And over the medium term, hopefully urban consumption also, starts coming back once, job creation, etc., start taking place at a faster pace. But the challenge still remains that India is simply not creating enough number of good quality jobs. It is creating jobs, so there's no doubt about that. But in the context of the requirement of job, that is where the big challenges. And if you look at incrementally, and this is a lot of government data based on the periodic labor force survey which the government does, incrementally what we are seeing is a lot of rural female new workers are ending up in agriculture, and a lot of urban maid workers seem to be ending up with the gig economy, where income levels are not going to be very high anyway. So that is one of the big challenges in India, that we are not creating enough number of good quality jobs in the high-end services or manufacturing, etc., which means a lot of people are ending up in somewhat low-paying jobs, I would say, which is what resulting in this cyclical slowdown. And until we fix the job issue, clearly this will be a problem for the medium term also. The structural element is what I talked about. It's just a lot of dysfunction now coming in across sectors, across categories, just not consumer, any other sector you pick up, it's the same issue. So, which is what my humble request to all investors, analysts, is that please start focusing more on the business models and how they're changing, what could be risk aware, and so on and so forth. Rather than just when you look at what has happened in the past, that is going to relevant in the future also, that is not going to be the case. And massive changes coming through. And somewhere the market has to start taking cognizance of these changes.
One of the arguments or points that, again, I've heard in recent months is that maybe in some cases, people are just not consuming more. So, for example, how much soap or how much more soap can you consume, or how much more toothpaste can you consume? So, are you sensing that as well in the way when you look at, let's say, again, sticking to consumer products and fast-moving consumer products?
I don't think that is the case. I think it is more a problem of affordability, I would say. Income levels not rising fast enough, I would say, because if you look at the usage in India, is still very, very low. Yes, penetration is very fast. So just about everybody has access, to let's say toothpaste and toothbrush and etc. But what was the usage? If I recollect some data, Colgate had shared a few years back, maybe it's still relevant. 80% of urban users I still think brush only one side in, and rural it's the other way around. You know, so the usage can definitely go up. The second thing is, immunization will continue. You know, as people income levels keep on rising, fine, they will be able to position to afford better products over a period of time. So it's not as if the companies do not have drivers. I think usage is still on lower side. That will increase over time. Privatization is new, all that stuff. It's just that the growth opportunity will be captured by more number of players. And whether the profitability will hold or not hold in a more corporate environment, that is something to keep an eye on. So I would assume you should prepare for lower growth rates compared to whatever you have seen in the past. Uh, yeah, there's a little bit of cyclical slowdown, but hopefully, the country will overcome that.
Right. So if we were to now look at companies that can outgrow this phase or can grow faster than this in this phase, what would they be? Or sectors that can grow faster in this phase where most earnings are under stress and valuations are obviously high?
I mean, if you step aside beyond the consumption sector, there's so many sectors which are growing very, very fast. So the entire manufacturing space, for example, will continue to grow at a very, very fast pace for a decent period of time, I would say. For the simple reason, India is not, manufacturing all the items it consumes. So over time, a lot more of those items will be produced in India. If you look at a simple thing like mobile phone, for example, as of now, we are still in the last mile stage of production of mobile phones. I mean, we are still importing most of the components from Far East Asia and assembling it over here. So technically, we are making mobile phones in India, and we are exporting also large number of mobile phones. But the components we are still importing. So over time, as the ecosystem start developing, we will start seeing more and more components getting manufactured in India also, all the way to the chip stage. And a lot of companies are focused on that. So the entire manufacturing um, space will probably continue to grow very, very fast. And I'm including, things like the entire electronic chain, solar PV modules, cells, and all the backend products over there, all the batteries, etc. So a lot of new sectors, sunrise also sectors, you will see very, very strong growth. Even in the consumption part, you are seeing decent growth in the high income household consumption. So anything to do with, let's say, hospitality, hotels, etc., travel, doing very, very well. Healthcare services, again, doing very well. I mean, for the simple reason, penetration of quality healthcare service is still very, very low in India. So that will, continue to grow as income levels continue to rise. So there are enough number of growth opportunities. So, that is not an issue at all in the country. And enough and more growth opportunities available for companies and several sectors which continue to grow at very, very fast rates.
And just to come back to the valuations question for a moment, you're saying that in cases like hospitality, travel, healthcare, or electronics, you're not seeing so much of a valuation stress?
The valuations are high over there, but the growth uh, runway is very, very long over there. So I'm less worried about the valuations over there. So see, if your company is trading at 70, 80p, it may look optically high, but if it's growing at 30, 40%, you can make some case over there. It depends on how long it goes. But if your company is growing at, if your company is trading at 50p, which is what is the case for many of the consumer staple companies or even some of the discretionary companies, and if the growth rate is low single digits, it becomes impossible to justify that valuation. It makes no sense. I mean, mathematically, it's impossible. Unless or until you assume a cost of equity, which is, sub 5%, there's no way you can justify in a 50B for a company which is growing at 2-3%. Absolutely doesn't make any sense. Very simple in math is, if you take cost of equity at 11%, even if you take 5-6% growth, let's say for the sake of argument, 6% growth. So that means 11 minus the 5%, so 1 upon 5%, that's 20%. That's 20p. So that should be the P of the company. Somewhere about 20p for a company which is, let's say, cost of 11% and growing at 6%. But the market is happy to give 50% for even growth rate, which honestly doesn't make any sense. So unless until the market is very convinced that eventually the growth rates will go back to much higher levels. But the science is not there, to be honest with you. And as we have written in the report also, a few years is good enough. By this time, I think people should start recognizing the fact that the fundamental changes afoot over here, and please take cognizance of that. Living in this, hope that at some point in time you'll see a recovery in volumes and top line and bottom line growth, I think is being a bit unrealistic, I would say.
So, when it comes to stock picking, and I guess we're venturing into more fundamental, maybe Benjamin Graham territory, but one of the things that investors, I'm talking about, including institutional in India, have tended to, or the approaches they've tended to use is to buy stocks or companies which are fundamentally good. And are good. When they say good, I guess there's a lot of they're more intangibles perhaps than tangible. So it could be governance, the quality of management, the consistency over time. So again, many multinationals fit into this. Maybe an HDFC Bank fits into this. So, and on the other hand, they may not, for prolonged periods of time, demonstrate growth in top line or bottom line. So, would they be part of your portfolio today, or would you have a different view?
See, things you have to keep in mind is the fact that, and I don't want to take anything from, Benjamin Graham or anybody, but see, the context are very different now. 30, 40 years back, you could sit back and look at a company and say, this sector will continue to grow. I have the best company over here, so I'm fine. The problem is, what we are seeing is that every sector, you are seeing so many changes now. It is becoming very hard here to have this, I would say buy and hold strategy for a very long period of time. Because you are seeing structural, massive structural changes in sectors you had no idea, about, 5 years back. Suddenly a lot more, disruption is coming forward. So obviously makes the task of, investing a lot harder. What you can hope for is that, the companies that are good as of now will be in a position to navigate those challenges. But then you can't make that assumption forever. Given the fact that, changes are happening at a very rapid pace, you have to be, confident about the fact that your chosen set of companies will be in a position to navigate the changes. So that means constant monitoring. You can't have that, if I have bought a stock and I will sleep over it next 10 years, it will be fine. And in 10 years, the whole industry will be gone for a while. So given the way things are changing these days, I mean, who knows what's going to happen to the investing industry? And for example, the way AI is, taking shape. It could be, machines investing and machines giving recommendations. You and I will all become irrelevant. Who knows, man? The way things are changing, so rapidly. The only thing I can hope for is, that you are fast enough to stay ahead of the changes. That's all you can
Yeah,
hope for, I would
yeah.
say.
I'm reminded. I mean, what we've seen literally in recent weeks from the Chinese car companies. I mean, who are essentially mobile phone makers or battery companies just a year or a couple of years ago, and who are essentially, overturning the entire automobile market, global automobile market, and they could do more if they were maybe allowed into markets that they're currently not allowed into, including the United States.
Absolutely. I mean, it's, amazing the way things are changing here, and it's going to be a lot more fun. That much I can assure you. Challenging but fun.
Right. So if to come back to where we are right now, we've entered the Q1 earnings season, and for the last 12 months or so, we've been hoping that every subsequent quarter we'll see an uptake and things will start improving because, to your point earlier, we are in the middle of a more cyclical downturn rather than a structural one. So are you seeing those signs now? I mean, as we are here in the month of July 2025?
Not in, I would say, the consumer space. It still looks like really challenged situation out there. Only in the rural part, we're starting to see some recovery. See, the hope is that, Govind, between a combination of the income tax cut, so that allowed by the government, the budget, 1 lakh also benefit given to income tax payers, 2 decent crop seasons, which has already resulted in some revival in the rural economy, 100 basis point rate cut by the RBI, and lower inflation. Hopefully, some combination of this should result in some recovery in consumption. But what we need is definitely a situation where more jobs start getting created and more jobs in the, let's say, reasonably, I think, jobs which can be in manufacturing and high services, not in agri and lower services. So that structural force is still some time away, I would say. You could see some recovery based on the fact of these 4 facts which I highlighted. And in the second half of next year, assuming the pay commission gets implemented, you will probably see some increase in the paying or spending capacity of the government-related household also. So hopefully some recovery in consumption as we go forward, and then structural forces hopefully take shape. Yeah. My worry is in the short term is you're going to see a slowdown in the investment part. And that's been one of the biggest drivers of the Indian economy in the last 4 years. And within investment, you look at it been two drivers, which is government spending and household
Private.
spending, which have been the not private household, which have been the big drivers here. Now, if you look at the government's own numbers and talk about the central government over here, you have seen a flattening of the government's capex numbers, by the way.
Yeah.
Especially for some of the big core infrastructure sectors like railway and road, we are not seeing any growth now. In 26 B numbers, if you compare with 25 numbers, I think there's 0 and 5% decline for the two sectors. And whatever growth you are seeing in the overall 7% growth for central government capex, that is also coming in sector which I don't think the government will be able to spend on, to be honest with you. Yeah. So that is one problem. You are going to start seeing some slowdown in government expenditure. And the related problem over there is that, I don't think the central government can incrementally spend a lot more money in railways and road. That's a separate point of discussion. But I think we are picking out over there in terms of the possibility to spend over there, I would say. It will sound like a very strange argument, but I think highway network in India is largely built. We can still add to it, but the pace of new highway additions will slow down dramatically. Railways also have seen a lot of development which were done in the last 10 years or so.
And upgradation.
Etc. Yeah, all that is that in my view. So unless until we plan a big, high-speed railway network, I think railway expenditure also is going down. So that is one issue. And state government unfortunately do not have the money to spend. Most of them are running at 3% state fiscal deficit to state GDP. Yeah, so they can only go in line with normal GDP at best. Yeah, and if you look at other item, which is household capex, you had a very nice residential real estate cycle starting from 2020 to now. Yeah, it's still continuing, but looks like there could be some slowdown over there. It's still not visible. But the worry which I have is the affordability, which had improved dramatically between 2014 and 2022, because real estate prices hadn't really gone anywhere in the last in that period between 14 and 22, pretty much across the 6 major metropolitan markets. If you leave aside Hyderabad, prices are pretty much flat here in nominal terms, which means real term prices have gone down, incomes have still been growing. My worry is in last 20 to 18 months, we have seen very steep increases in prices in most of the metropolitan markets, barring Bombay. Yeah. So that will result in affordability again getting hit and maybe some slowdown in residential real estate going forward. So far, we are not seeing a signs of it, but keep an eye on that one. So you have a situation where consumption may start picking up a little bit, as we discussed based on the 4-5 factors which we discussed. But at the same time, you could this year onwards, you could possibly see some slowdown in investment rate, yeah, which means it is very unlikely we'll see a big acceleration in GDP growth. So versus 6.5% last year, we're looking at 6.2% this year.
If I were to come back to, we talked about two aspects of expenditure or spending. You talked about government spending or public spending, and you talked about household. And let me sort of quickly ask you about private capex as well, which of course has been steady to stagnant in recent years. There was a time, and I'm sure that maybe it still is, depending on which example, is that a company says, okay, I'm going to expand capacity, I'm going to go into a new market, or I'm going to acquire, and the stock market rewards that because that's a sign of growth. And we haven't really seen that, at least as an element of excitement or interest in a stock. How are you seeing this as a signal, or or the fact that there is no real signal, or there are not enough signals of growth and capital growth and capital expansion?
I should have addressed that. Say private spending, we're not seeing any signs of any real acceleration over there. And if you look at the data over here, between 19 and 24, that's the last data which we have from the RBI, private corporation spending as a percent of GDP, which was 11.6% of GDP in 2019, has gone down to 11.2%, which means it will going at lower than nominal GDP growth rates. Yeah. Compared to that, if you look at government spending between the public sector and the government, that number has gone from 7.3% to 7.9%. So clearly you have seen a big acceleration over there. And particularly between 21 and 24, the number has gone from 6.8 to 7.9%, massive acceleration as you can imagine, right? And the same thing is true for the household part also, 10.8% take up, 12.8% on in the last 3 years, which means they're growing much faster than nominal GDP growth rates. Yeah? So coming back to the private sector, the challenge over there is that, to be honest with you, there are far fewer sectors which the private sector is keen to invest in now compared to, let's say, 20 years back. If you look at 20 years back, you had several sectors which have been opened up for private sector investment, whether it was roads, whether it was, upstream oil and gas, electricity Act of 2003, if you recollect, and so on and so forth. Yeah. And between 2004 and 2008, and if I remember correctly, private capex as a percentage GDP used to be less than 6%. That went up to 14%, by the way, yeah, in a matter of 4 years. And then it eventually tapered down to 11-12%, and it's been stuck in that band, for forever. And at that time, the private sector was very keen to invest in 5 broad areas, and the opportunities were humongous at the time. You had the entire electrification part. That is, at that time, it was coal-based electricity generation. The entire metal mining sector, remember, you had a massive, global commodity cycle linked to growth in China. Then oil and gas. Reliance was investing in a big way in that sector. Roads and telecom. Remember, at one point in time, we had 40 telecom companies. So if you fast forward to now, we have a situation where the private sector seems to be keen currently to invest only in electrification, which continues. So now we have, solar, wind, renewable electricity generation, and all the ancillary industries, the solar PV module cells, all that stuff. So thankfully, a lot of progress over there that continues. And beyond that, we are seeing some investment in metal mining. At this point in time, or at least it looks like to me, even in the future, very unlikely the private sector is going to be setting up a new refinery or investing upstream in a big way. Very, very unlikely, right? Roads is largely done as we discussed. And telecom, you have, effectively 3 players now. And Vodafone Idea not even in a position to invest aggressively. And also the 5G capex is largely done over there. So that will also start to slow down. So that is the whole issue over here, which somewhere the market is not recognizing that the private sector has far fewer opportunities to invest in compared to what it used to have earlier. The 5 big core infra sectors have reduced, in my view, too, currently. And that may be the case. Where the private sector can do more investment is more in manufacturing. But honestly, manufacturing, the way India is doing it currently, which is still last mile assembly work, does not require a lot of capex.
Capex.
The asset turnover ratio in manufacturing is something like 7 on an average, if you look at across various sectors of manufacturing. So only when we get into the component in the upstream stage of manufacturing, and hopefully seeing a lot of progress over there, that is when maybe you start seeing big private sector capex eventually coming through. But if we continue with last mile assembly work, I don't think you're going to see any big pickup in private sector capex now. So that is the challenge over here. That number one, the opportunities for the private sector investment have dwindled significantly. And number two, again, which is something not discussed that often, is the number of risk takers in the economy has also declined dramatically. Right? You had so many more companies in the past who were willing to invest in the core infrastructure sector. And obviously, a lot of companies, over-invested, overstressed the balance sheets, eventually, went bankrupt. But the assets did get created. Whether it is in the electricity power sector or in steel. We have so many companies at one point in time, built coal-based thermal plants, steel plants, whatnot, but eventually they went bankrupt. But the assets are there, now owned by, the larger entities now. So that is a problem over here, fewer opportunities, fewer risk takers looks like to me in the private sector.
And that's I must at the later point draw you back into a conversation which is I think very interesting and fundamental. Have the number of big risk takers in India reduced, and why so, and whether that can change. But that's a different conversation. So we're sort of running out of time. So let me ask you one or two quick questions, Sanjeev. So if you were to construct a portfolio in these times, keeping in mind everything that we've discussed, what would you or how would you do so? And I'm obviously mean sectorally.
Sure. So you start with the process of elimination because everything is expensive. at this point in time, I would say fairly valued to expensive. So you start with the sectors which you clearly want to avoid. So most of the consumption I would avoid, given the fact that they're trading at very, very
Mm.
high multiples in the context of growth and the medium term issues. I will have no, issues about, let's say a company not going for 1 or 2 years. But if I am really not looking at, growth even 2 5 years down the line, then you have a problem why I'm paying 50p in that case, right? So that is zero in the water portfolio which we have. IT continues to run through it, given the headwind which the sector is facing. Not that the growth opportunity not there in the medium term, but in the short term, at least, seeing a lot of, I would say, headwind in the form of the customers of the IT service company not in a position to decide, given all the uncertainty linked to global geopolitics and tariff issues and whatnot. Yeah. So those are the two sectors which we are extremely light on. Other than that, cement, etc., small sectors, I really don't understand the valuation of those sectors, so that is also out. So where we have some, constructive view, one is the entire financial services space. Look here, the sector has done well over the last 12, 18 months. There are some short-term headwind in the form of NIM compression for banks, which is very well known. Asset quality issues looks like under
Mm.
control. Multiples look fair, so I am not making a case for relating in the multiples over there. You will probably not see a lot of growth in earnings this year, that is FY 2026. But the book will still compound with whatever the ROE of the banks and NBFCs. And most of them are doing, let's say the PSU banks are doing between 10 to 12, 13% ROE. The private sector banks are between 14 to 16%, and NBFCs are slightly higher. So hopefully book compounds, the multiple stays where it is, the price to book multiple remains stay where it is. So you make some money on compounding in the book itself. So that looks fine to me. Healthcare services, broadly speaking, again, sector which we like. So domestic pharma is something which we like because most of the company delivering, high single digit, low double digit kind of growth rates. Multiples are high, but I think I can live with that problem in the context of what I'm seeing otherwise in the market. Yeah. Healthcare services, which is hospital, diagnostics, we actually like the sector a lot. Yeah, maybe traditional well, over there, but these companies are delivering fantastic growth, and I think they're continuing to go at very, very high rates for a long period of time. So that we are okay with. And then you have to be, picky a few stocks in there depending on their growth profiles. So we like some of the high-end discretionary, consumption sectors. For example, stocks, for example, Zomato or Indigo, which are playing at the very high income household, consumption, long runway of growth. And at least the market structure there look reasonably safe in the sense, you have two players in the food delivery market, you have especially two players in the civil aviation segment. So long opportunity, large opportunity, long runway of growth, consolidated market already looks fine to me. And then we have Reliance, Bharti, etc., which are more plays on telecom, expecting a tariff increase at some point in time. Good defensives also, I would say. So that's about it, in terms of how we have constructed the portfolio, where we are constructed on, and and what we don't like currently.
Hmm. It's interesting you mentioned, since you mentioned it again, you mentioned Zomato and Indigo. So one is very profitable and the other is very loss-making. So how does that square up?
Well, see, the thing is, when the food delivery business is doing, pretty well, right? You're still seeing, 17, 18% revenue growth over there, and the runway of growth is pretty strong over there. The loss making part is more coming from the quick commerce business. So yeah, there is a lot of competition, hyper competition. Clearly, at this point in time, you have three pure quick commerce companies, and then you have the arms of your modern retailing companies also all slugging it out. So it is possible that the losses could sustain over here for a longer period of time, depending on the competitive intensity. But I think that the business model is great. I think I'm honestly surprised by the way this quick commerce is caught up in India. I was thinking, why would anybody pay extra to buy, let's say, long lead items which will sit in your pantry for a long period of time. But Indians seem to be paying, for just the convenience, of having, good delivered at home. It's pretty amazing, and the trend should likely continue. Penetration levels of quick commerce are still very, very low. There's long runway of growth over there. So at some point in time, the business will become profitable. Hopefully, consolidation will happen. But even just because the market opportunity itself, becoming much larger in the next 3 to 5 years time and look at the growth rate, they're all doing 100% plus kind of a growth rate. So over time, what you will start seeing is the job, working in the right direction. Revenues keep going up on a, per unit, let's say, even if it remain the same, revenues going up, per unit cost starting to come down, which means the profitability job even starts becoming better over time. So that's what we are looking at. Currently, obviously, the unit cost, the economy does not work, but as volumes keep on increasing, unit cost will start coming down, and hopefully, the economics will become a lot better.
Right. Sanjeev, before we go, let me ask you slightly, maybe, I don't know, abstract question. So in all the years that you've been in the market, what would you say was the most exciting phase, or are we still in one?
Different levels of excitement, different types of excitement, I would say. I don't know. I mean, see, these days I don't focus that much on my strategy part anyway, since I focus more on running the business. But yeah, I mean it's a different levels of excitement in different times. But see, a lot of things are happening now, and looking at 30 years of being in this market now, when the stock analysis used to be fairly simple, job, companies were relatively simple, sectors were less complex, pace of change was glacial, etc. Nowadays things have become a lot more complex. The pace of change is very, very high, as we discussed. Across sectors, you're seeing so much disruption. 5, 10 years down the line, who knows whether the industry relevant, company relevant, so that way it is a lot more exciting. The pace of change itself is, humongous, I would say. So that way you have to be a lot more sharper now, be very, very cognizant of all the changes that are taking place around you and be adapt to adapt to the changes. Otherwise you are toast, in this market.
Right, Sanjeev. It's been a real pleasure speaking with you. Thank you so much for joining me.
My pleasure. My pleasure. Thank you.